Welcome to the deep dive, where we kind of take all those sources that you give us and we try to break them down into like the most important insights.
Yeah,
It's like your little shortcut to becoming super well informed on any topic without, feeling like you're going to drown in information.
right.
And today we are going deep into financial statement analysis and valuation.
Okay.
And we're using excerpts from a textbook called JaneESM1.pdf as our guide for this deep dive.
Cool.
So what we're trying to do today is understand why financial reporting even matters in the first place, and then how to analyze those reports intelligently so that we can figure out what a company is worth and, what kind of risks they might be facing.
Yeah, that's exactly right. You've given us a really comprehensive textbook here. And I think, what we want to do is extract kind of that core logic behind, dissecting these financial reports.
Yeah.
It's not just about the numbers themselves, right? It's what do the numbers tell us about, the underlying business and how it's going to perform in the future.
Yeah. And speaking of like the core logic of it all,
Mhm.
um, the textbook lays out this six-step framework for financial statement analysis and valuation.
Yeah.
So I figured that's probably a pretty good place to start.
Absolutely. That six-step framework really is kind of the bedrock of any intelligent analysis.
Okay.
And so, the first step in this framework is all about understanding kind of the big picture,
Okay.
right? So it's evaluating the economic characteristics of the industries in which a firm operates and then the current conditions of those industries,
Yeah.
right? Because you can't really understand a company's financials in a vacuum.
Right.
You got to understand the environment that it's operating in.
Yeah, like trying to understand why a company that sells raincoats is doing terribly if you don't realize there's a drought going on.
Exactly.
So you got to have that context.
That's a great example. Yeah, the industry context is absolutely crucial.
Okay, so that's step one, kind of like setting the scene. And then step two is like putting the company on that stage.
Exactly. Step 2 focuses on understanding the strategies that the company is executing to compete in those industries.
Okay.
So, are they trying to be the low-cost leader? Are they differentiating their products or services?
Okay.
Are they focusing on a specific niche?
Yeah.
Um, their financial results are going to be a direct reflection of how well they're executing these strategies.
Okay.
And it also, gives you as the analyst a framework for understanding why certain numbers might look the way they do.
Okay, so we've got the industry landscape with step one. We've got the company's strategic positioning, how they're playing on that field in step two.
Right.
Now it feels like we should be getting into the actual financial statements.
We are getting close.
Okay.
So step 3 is where we actually start to, link those strategies to the financial reports.
Okay.
So it's about assessing how well the financial statements reflect the economic effects of the strategic decisions and actions that the company has taken.
Okay.
And this is where understanding accounting principles becomes really important.
All right. We have U.S. GAAP. We have IFRS mentioned in the text.
Yeah.
We need to think about, how reliable is this information? Is there anything that we as analysts need to adjust to get kind of a truer economic picture?
So it's not just taking the numbers at face value, it's understanding like the rules of the game.
Exactly.
And
Yeah.
maybe even looking for areas where they might be bending the rules a little bit.
Exactly. You have to have a healthy dose of skepticism.
So what are some of those areas where we might need to make adjustments or where companies might be, presenting things in a way that maybe we need to look a little deeper at?
Well, one common area is revenue recognition,
Okay.
especially for companies that have complex contracts or, bundled services.
Yeah.
Management might be incentivized to, accelerate revenue recognition to make the short-term results look a little bit better.
Yeah.
Another common area is with discretionary expenses,
Okay.
things like, marketing or research and development.
Where management could cut back in those areas to boost profits in the short run.
Right.
But that might hurt the company's long-term growth prospects.
Right. So they might be sacrificing the future to make the present look a little rosier.
Exactly. And, understanding these potential biases is a key part of that third step.
Okay, so once we've kind of like, looked under the hood, made sure that the accounting is, reasonably sound, or at least we understand the areas where it might not be, Then step 4 is where we actually dig into the numbers to assess profitability and risk.
Precisely.
Okay.
Step 4 involves using financial ratios and other analytical tools to really evaluate how profitable the company is
Yeah.
and, what potential risks is it facing.
Okay.
And so this is where we would look at things like, profit margins, return on investment,
Okay.
debt ratios, things like that to really quantify, their performance and their stability.
Okay. And those are kind of the metrics that come to mind, I think, for a lot of people when they think about analyzing a company. And then step 5 is about looking into the future, trying to forecast that profitability and that risk going forward.
Exactly, but it's not just blind guessing.
Right.
Step 5 involves using, what we've learned about the industry, about the company's strategy,
Correct.
about its historical performance to build a reasoned expectation of what the future might hold.
Okay.
And then that forecast becomes a really important input into that final step.
Which, of course, is valuation step 6,
Yes.
where we try to figure out what is this company actually worth.
Exactly. And in step 6, we use various techniques to come up with an estimate of the intrinsic value of the firm.
Okay.
And then crucially, we compare that value to the current market price
Right.
to help us make investment decisions.
So are they underpriced or overpriced, basically?
Exactly. You got it.
Okay.
The entire 6-step process is really designed to lead you to that informed conclusion.
It's like a nice step-by-step process. It makes me feel a lot more organized in my thinking about this.
It's a disciplined approach. It moves you away from just looking at, a few headline numbers
Right.
and encourages you to think much more holistically and thoughtfully about the business.
Okay, so the textbook lays out this framework, but it doesn't just stay in the theoretical realm, right?
No, not at all.
It sounds like it gives a lot of concrete examples and problems using real companies
It does.
to make these concepts kind of come to life.
Exactly.
So which companies do we see in here?
Well, the excerpts mention examples and problems involving companies that you'd probably recognize, like Walmart,
Okay.
Biosante Pharmaceuticals, prepaid legal services, Nike.
Okay, familiar names.
Yeah, and there's even an integrative case on Starbucks that sounds like it pulls together a lot of the different analytical techniques.
So cool.
Yeah.
So yeah, seeing those familiar names I think helps a lot, and the excerpts highlight specific chapters that go into different parts of this framework in more detail.
Right.
So for example, Chapter 3 focuses on the statement of cash flows.
Yes, chapter 3 is all about, income flows versus cash flows, and it's so important because that's where we really start to assess the quality of the accounting,
All right.
and understand the economic reality behind the reported profits.
Yeah.
So it digs into the statement of cash flows, how it relates to a company's product life cycle, even how to prepare a statement of cash flows if you weren't given all of the information.
Okay.
And then, it also talks about EBITDA, which is earnings before interest, taxes, depreciation, and amortization.
Yeah.
A very widely used metric. But the chapter also, emphasizes how to use cash flow information to really gauge the quality of a company's earnings.
Yeah.
A company can show big profits on the income statement.
Right.
But if they're not actually generating cash, that's a red flag.
Yeah, because at the end of the day, cash is king, right?
You got it.
A profitable company that's running out of cash is not a company you want to be invested in.
That's a great way to put it.
Okay, so Chapter 3 is all about cash flow. And then it seems like Chapters 4 and 5 go hand in hand, focusing on profitability and risk.
Yes, exactly. And what's cool is that they analyze several companies across both of those chapters.
Okay.
So we've got Hasbro, Abercrombie, and Fitch, Coca-Cola, Starbucks, Walmart.
Wow, that's a lot.
I know, right?
Yeah.
So chapter 4 is all about, different ways to analyze how profitable a company is.
Okay.
Chapter 5, looks at different aspects of its financial risk.
Okay.
And the chapters also have some really cool case studies at the end.
Oh, cool. What kind of cases are we talking about?
Well, there's one on risk analysis for Starbucks.
Okay.
There's one on credit risk for a company called Massachusetts Stove Company.
Go.
One on bankruptcy prediction for Fly By Night International Group.
Catchy name.
I know, right? And then one that I think is especially important, one on financial reporting manipulation
Okay.
at a company called Millennial Technologies.
I feel like that one would be really eye-opening just to see, like how companies might try to manipulate the numbers and then how you would actually go about detecting that.
Yeah, absolutely. It really gets to the detective work involved in financial statement analysis.
Yeah.
And why that third step of assessing accounting quality is so crucial.
Okay, so we've got profitability, we've got risk, and then Chapter 6 shifts gears a little bit to focus on how companies finance their operations.
Yes, Chapter 6 is all about, the accounting for those financing activities.
Okay.
So it covers things like, issuing stock, common stock, preferred stock,
Okay.
the payment of dividends, share repurchases,
Okay.
accounting for stock options that companies grant to employees,
Okay.
various liabilities, different types of debt
Oh,
leases.
yeah. Leases. That's a big one these
Yeah,
days.
capital leases, operating leases, the whole thing.
Right. And there's been so many changes in the accounting for leases recently.
Exactly. It can be really complicated to figure out, what a company's true obligations are.
Right. And then there's this whole concept of off-balance sheet financing, where companies might be structuring things in a way to keep debt off of their main financial statements.
Exactly. So you have to dig a little deeper to find it.
Okay, so Chapter 6 is all about the financing side. And then it seems like the textbook also uses PepsiCo as this kind of recurring example throughout to really bring a lot of these concepts to life.
It does. It seems to be like a central case study that they come back to again and again.
Okay, and PepsiCo, I mean, everybody knows Pepsi, right?
Yeah.
So I think it helps to have that kind of familiar company to think about these things in the context of.
Right. And what's cool is that they've actually included PepsiCo's financial statements in the appendix.
Oh, nice.
So you can really see all of these concepts in action.
Okay, so what are some of the things that they highlight about PepsiCo?
Well, one thing is their degree of integration in the value chain.
Okay.
So, you can think about a company like PepsiCo or Coca-Cola. They're really focused on the high profit margin parts of the business, creating the concentrate, building those brands.
Okay.
But they often rely on independent bottlers for the more capital-intensive work.
So the actual bottling and distribution is often done by separate companies.
Exactly, and that can affect their reported profitability metrics. It can affect their apparent risk profile.
Okay.
Because, the bottler's debt, for example, isn't going to show up on PepsiCo's balance sheet.
Right. So you got to be careful about comparing them directly to other beverage companies that might be more vertically integrated.
Precisely.
Okay, so that's the value chain integration. And then they also talk about geographical diversification, right?
Yes, the notes to their financial statements provide a lot of detail on PepsiCo's operations in different countries.
Okay.
And this is really important for understanding, where their revenues are coming from
Right.
and what kind of economic or political risks they might be exposed to in different regions.
Yeah, that makes sense. And then there's this whole discussion around intangible assets.
Ah.
Like PepsiCo's brand names and the goodwill that they've accumulated from acquisitions.
Right, and this highlights a really important point about accounting.
Okay.
So intangible assets that are acquired, when you buy another company,
Yeah.
those are recorded as assets on the balance sheet because there's transaction value associated with them.
Okay.
But intangible assets that are developed internally,
Yeah.
like the Pepsi brand itself,
Right.
those are generally expensed as they're incurred.
Okay.
Because it's harder to put a reliable value on something that you've created yourself until it's actually sold.
Yeah, you can't just say, oh, our brand is worth billions of dollars.
Yeah,
You have
exactly.
to have some kind of external validation.
Right.
Okay. So that's intangibles. And then they also use PepsiCo to talk about how liabilities are reported.
Yes. So long-term debts are typically reported at their present value,
Okay.
while short-term obligations are recorded at the expected payment amount.
Okay.
And even things like deferred revenue,
Oh.
like from unredeemed gift cards.
Great.
They use examples that are relevant to a company like PepsiCo to explain how those are treated.
So it just makes those accounting rules a little bit more tangible, a little bit more understandable.
Exactly.
Okay. And then it sounds like the forecasting step also uses PepsiCo as an example.
Chapter 10 specifically focuses on how you might go about forecasting PepsiCo's financial statements for the next 5 years.
Oh, wow. Okay. So they get really specific.
Yeah, and this is a critical input into the valuation process,
Yeah.
but it's also one of the most challenging parts because you're inherently making assumptions about the future.
Right. You don't have a crystal ball.
No, you don't.
Okay. So that's forecasting. And then moving away from PepsiCo for a moment, the excerpts also really emphasize the relationship between a company's income flows, as shown on the income statement,
Yeah,
and its cash flows, which are detailed on the statement of cash flows.
absolutely.
And I think this can be a source of confusion for a lot of people.
It can. People look at the income statement, they see net income.
Yeah.
They think, okay, that's how much money the company made.
Right.
But it's not that simple.
Right. It's not just about the profit. It's also about the cash.
Exactly. And the statement of cash flows bridges that gap.
Okay.
It shows you how the reported net income translates into actual cash coming in and going out of the business.
Okay.
And the textbook explains the two methods for preparing this statement,
Okay.
the direct method and the indirect method.
And what's the difference?
So the direct method, you're basically listing out all of the cash inflows and outflows
Okay.
from the company's operations.
Yep.
And the indirect method, which is more commonly used, starts with net income and then adjusts it.
Okay.
And they even mention CVS Caremark as an example of a company that uses the direct method,
Okay.
but they still provide that reconciliation back to net income, which is essentially what indirect method is doing.
So it's kind of like two different ways of getting to the same place.
Exactly.
Okay. So with the indirect method, we're starting with net income and then we're making adjustments.
Right. And there are two main types of adjustments,
Okay.
non-cash adjustments and then changes in working capital.
Okay. Break those down for me.
Sure. So non-cash adjustments are things that affect net income,
Yeah.
but don't actually involve any cash coming in or going out.
Okay. Give me some examples.
Sure. So depreciation is a big one.
Okay.
That's the expense that we recognize for the wear and tear on our assets over time.
Right.
Amortization is similar, but it's for intangible assets.
Okay.
Then we have deferred taxes, which arise because of timing differences
Okay.
between when we recognize income and expenses for accounting purposes versus tax purposes.
Okay.
And then we have gains or losses on the disposal of assets.
Okay.
You know, if we sell a piece of equipment for more or less than its book value.
Got it. And then what about changes in working capital?
So working capital refers to, the difference between our current assets and our current liabilities.
Okay.
And so changes in accounts receivable,
Yeah.
inventories, accounts payable, those all affect the cash that we generate from our operation.
Okay. So even if our sales are going up, if we're not collecting that money from our customers,
Right.
that's going to impact our cash flow.
Exactly.
Okay. And the textbook gives some examples of how PepsiCo makes these non-cash adjustments, right?
It does. Their depreciation and amortization expense is pretty significant.
Okay.
So that's a good illustration of how those non-cash items can affect the statement of cash flows.
Okay. And there was also this this thing about how tax benefits related to stock options are treated on the cash flow statement.
Yeah, that's a little bit of a quirk in the accounting.
Okay.
So normally all tax payments are just classified as part of operating cash flow.
Okay.
But when employees exercise stock options,
Uh,
the tax benefit that the company receives is treated a little differently.
Okay. How so?
So it reduces the company's tax expense on the income statement,
Okay.
but then it's actually deducted in the operating section of the cash flow statement
Okay.
and then shown as a cash inflow in the financing section.
Oh, so they're kind of splitting it up.
Exactly.
Interesting.
And the textbook even refers to these as excess tax benefits to highlight that special treatment.
Okay.
And PepsiCo's statement of cash flows, provides a good example of this.
So we can actually see it in action.
Yeah.
Okay, so it really just underscores how this statement of cash flows gives you this much richer understanding of a company's financial health
Yeah.
than just looking at the income statement alone.
Exactly. You're getting the full picture.
Yeah. Okay, so now we're talking about this concept of earnings quality,
Right.
which sounds like a really crucial thing to assess.
It is. Earnings quality is essentially how well the reported earnings reflect the company's true economic performance.
Yep.
And, are those earnings likely to be sustainable in the future?
Okay.
And the textbook, talks about how income increasing accruals.
Okay.
So these are non-cash accounting items that boost reported profit.
Yeah.
They can actually be a red flag that earnings quality is lower. Exhibit 319 in the textbook even suggests that, companies with higher levels of these income increasing accruals, they actually tend to have worse stock returns down the line.
Oh, interesting. Yeah.
Yeah, maybe because investors initially overvalue them.
Oh, so they're fooled by those inflated earnings.
Exactly. You have to look beyond the headline numbers
Right.
and really understand what's driving them.
So don't just assume that a company with high profits is a good investment.
Exactly.
You have to look deeper.
You got it.
Okay, so moving on to Chapter 4. Now we're getting into profitability analysis.
Yeah.
What are some of the key things that we should be focusing on?
So Chapter 4, emphasizes net income as that primary measure of profitability.
Okay.
It does mention comprehensive income.
Yeah.
Which includes some items that don't flow through the income statement.
Right.
But interestingly, the research that they cite suggests that net income is actually a stronger predictor of future stock returns
Okay.
for most companies, except maybe those in the financial industry.
Okay. So net income is king for the most part.
Yeah, pretty much.
But then the chapter goes on to talk about all these different ways to slice and dice profitability, right?
Yeah. Yeah, there are a lot of different techniques.
Like what?
So we have per share analysis,
Okay.
looking at, basic EPS, diluted EPS.
Okay.
They use Cat Corporation as an example for basic EPS calculation.
Okay.
A common size analysis where you express each line item as a percentage of sales. Percentage change analysis, looking at how figures have changed over time.
Yeah.
Alternative measures of income.
Okay.
And then, they also talk about the challenges you face when you're trying to compare profitability across different business segments within a company or across different companies, because there can be variations in how they disclose that information.
Right. So you have to be careful about comparing apples and oranges.
Exactly. You got to make sure you're comparing with.
And then they get into, key profitability ratios at different levels of analysis.
Okay.
So at level 1, we're looking at overall firm profitability.
Okay.
With ratios like return on assets or ROA.
Okay.
And then return on capital employed or ROCE.
Okay. And what do those tell us?
So ROA tells you how efficiently the company is using its assets to generate profit.
Okay.
And then ROCE looks at the return that's generated on all of the capital that's been invested in the business.
Okay. And then level 2 breaks those down further.
Yes. So ROA, for example,
Yeah.
can be split into profit margin. Okay, so those breakdowns are really helpful for figuring out, what's actually driving the company's profitability.
Right. You're getting under the hood
Yeah.
and seeing what's really going on.
Exactly. Okay, so then they also talk about some of the things that can influence ROA,
Yeah.
like where a company is in its product life cycle.
Exactly. A company that's in their early stages of growth.
Yep.
They might have lower ROA because they're investing a lot of money,
Okay,
in building your business.
right. But then as they mature.
Right. Their ROA should improve.
Okay.
And then, the amount of flexibility that they have in trading off between profit margin and asset turnover.
So they might be able to, charge higher prices but sell less product.
Right.
Or they might have to compete on price and sell a lot more product.
Exactly. And they use PepsiCo's profit margin analysis as an illustration of these concepts.
Okay, cool. And then they also mention a few other ratios like accounts receivable turnover.
Yeah.
How quickly are they collecting the money that's owed to them?
Right.
And inventory turnover.
Mm-hmm.
How efficiently are they managing their stock?
Right.
And they use Starbucks and Microsoft and Oracle as examples.
Yeah. Highlighting, how those ratios can vary significantly
Yeah.
across industries.
Okay, so profitability analysis, we're really trying to get this detailed understanding of how are they generating those profits?
Yes.
How effectively are they using their resources?
Right.
And recognizing that, different industries are going to have different benchmarks.
Exactly.
Okay, so now we move on to risk analysis.
Yes.
Which is the focus of Chapter 5.
Chapter 5 is all about, providing a framework for analyzing financial statement risk.
Okay.
And they really connect a company's ability to generate cash and its need to use cash for
Yeah.
its operating activities, investing activities, financing activities
Okay.
to different types of risk.
Okay, what are the different types?
So there's short-term liquidity risk.
Okay.
Can the company meet its short-term obligations?
Okay.
And then long-term solvency risk. Can it meet its long-term obligations?
Okay.
And then the chapter also talks about financial flexibility.
Okay, and what's that?
So financial flexibility is basically the company's ability to raise capital if and when it needs to.
Okay, so it's not just about do they have enough cash right now, it's also do they have the capacity to get more cash if they need it?
Exactly.
Right.
Can they weather a storm?
Right.
Can they access funding when necessary?
Okay, so then the chapter goes into these specific ratios that we can use to assess these different types of risk.
Right. So for short-term liquidity,
Yeah.
we've got the current assets over current liabilities.
Okay.
Quick ratio,
Yeah.
which is similar, but it excludes inventory because that's a less liquid asset.
Right.
And then operating cash flow to current liabilities.
Okay.
And they actually use PepsiCo's 2008 ratio for that.
Oh,
It suggests that a benchmark of 0.20 is a healthy level.
okay, so they're giving us some actual numbers to work with.
Exactly.
And then for long-term solvency, we've got
Long-term debt ratio, total liabilities to total assets, operating cash flow to total liabilities interest coverage ratio.
and Are they giving us benchmarks for those as well?
Well, they use PepsiCo's 2008 data for several of those,
Right.
and again suggest that that 0.20 benchmark for operating cash flow to total liabilities is a good indicator of healthy long-term solvency.
Okay.
And based on those ratios, back in 2008, they suggested that PepsiCo had relatively low long-term solvency risk,
Okay.
although they did note that their leverage had been increasing over time.
So potential warning sign.
Right. Yeah. You always want to look at the trend.
Okay, so we've got short-term liquidity, we've got long-term solvency, and then they also talk about bankruptcy prediction.
They do. They talk about how, there are statistical models
Okay.
that try to predict the likelihood of a company going bankrupt.
Okay.
And these models often use a combination of financial ratios.
Okay, so the same ratios that we've been talking about.
Yeah,
Yeah.
exactly. And they mentioned Altman's Z-score, which is a very well-known bankruptcy prediction model.
Okay.
Although the specific details of the Z-score aren't in the excerpts.
Okay.
But, it's worth noting that these models exist.
Yeah.
And then they also make this really interesting connection between financial leverage
Yeah.
and market equity beta,
Okay.
which is a measure of a stock's volatility relative to the market.
Right.
And the idea is that, companies that have more debt,
Yeah.
their stock price is going to be more sensitive to economic downturns.
Right, because they have those fixed interest payments that they have to make.
Exactly.
Okay, and then the chapter ends with a reminder
Yes.
about financial reporting manipulation.
Always important.
Yeah, that, we can't just blindly rely on the numbers.
Right. We have to do our due diligence.
Right.
We have to assess that risk of manipulation
Okay.
before we can really use those financial statements to make judgments about risk.
Okay, so it all comes back to accounting quality.
It does.
Okay, so now we're getting into the last few chapters that the excerpts cover,
Right.
chapters 6 and 7, which focus on financing activities, leases, and intangible assets.
Right. So Chapter 6, provides more detail on the accounting for equity financing.
Okay.
So we're talking about, common stock,
Yeah.
preferred stock.
Okay.
It highlights, the trade-offs with preferred stock.
Okay, what are those?
So preferred stockholders typically don't have voting rights,
Okay.
but they have a preference when it comes to receiving dividends.
Okay, so they get paid first.
Exactly. They're higher up in the pecking order.
Okay.
The chapter also discusses, how companies distribute profits to shareholders through dividends,
Yeah.
how they might buy back their own shares,
Okay.
the accounting for stock options, which are a common form of employee compensation,
Okay.
and then this concept of other comprehensive income, or OCI,
Okay.
which includes certain gains and losses that don't actually flow through the income statement.
Okay, give me an example.
Sure. So unrealized gains or losses on foreign currency translation,
Okay.
that would go through OCI.
So those are gains and losses that haven't actually been realized yet.
Exactly. But they can still have a real impact on the company's financial position,
Right.
even though they're not hitting the income statement.
Okay, so OCI is kind of like this other bucket for things that don't fit neatly into the income statement.
Exactly.
Okay, so chapter 6 is equity financing, and then chapter 7 is all about leases and intangibles.
Yes. Chapter 7, really digs into that distinction between capital leases and operating leases.
Right, and this is an area where the accounting has changed a lot recently.
It has. Under the old rules, operating leases were often kept off of the balance sheet,
Right.
which made it harder to get a true picture of a company's obligations.